Hello. Even though a lot of people are worried about the economy because of the trade war, the numbers are actually looking better. Fewer companies are defaulting on their loans, and fewer people are falling behind on credit card or car payments. There are three main reasons this is happening. First, the trade war isn't causing as much uncertainty as it did before. Businesses know more about what to expect so they can plan ahead instead of holding back or waiting. Second, the rise of artificial intelligence or AI is creating a major boom. Companies are building new data centers and energy systems to power them, and that investment is helping the economy grow. Plus, higher stock prices are making people feel wealthier, which leads to more spending. It's called the wealth effect. The third reason is that we're seeing what some are calling an industrial renaissance. Industries like aerospace, defense, manufacturing, biotech, and robotics are expanding again, investing in technology and in jobs right here at home. So while the trade war is still a small obstacle, it's being outweighed by the growth coming from AI and this new wave of industrial innovation. If this continues, the economy could start growing faster again in the next few months. So here's what's going on in the markets right now. The Federal Reserve just cut interest rates for the first time this year, and the expectation is we'll have two more cuts before the end of the year. And that's helped boost confidence in US stocks. Lower interest rates usually make borrowing cheaper, which can be good for businesses and investors and real estate buyers. That shift in policy is making the stock market feel more supported than it has in a while. At the same time, there's still some worry out there, mostly about how expensive stocks have gotten and about the upcoming midterms. Even with all that, people are feeling a little more optimistic. For the first time in months, the government isn't seen as a drag on the economy. And tensions in the Middle East have eased a bit, which means investors are turning their attention elsewhere, like Russia, which is now viewed as a bigger risk. So overall, the market is feeling a bit better, but not completely calm. We're moving forward, but with one eye open. This chart highlights a powerful truth about long term investing. Bull markets last longer and climb higher than bear markets fall. It's no secret that we will have some sort of a correction here shortly, given the speed at which the markets have moved higher. Since 1961, bull markets in the US have averaged 64 months in length, with an impressive 184% average total return. While bear markets have been relatively short lived, lasting only 14 months on average, and declining 36%, this visual clearly shows that while downturns can be sharp and unsettling, they are typically followed by longer periods of strong growth. For investors, this underscores the value of staying invested during volatility because the upside over time has historically far outweighed the downside. Thanks for listening, and if you have any questions, please reach out.